Welcome to another episode of Divorce at Altitude. I'm your co host, Ryan Kalamaya. This week, we're going to talk about separate property and tracing with Andy Baum, who is at Harper Hofer and Associates. He is a certified public accountant, but he spends most of his time with litigation support with Preston Hofer, and we've worked on a number of cases together. He went to the University of Texas, so he is a proud Longhorn. He spent some time out in California. We'll talk about that and how he got into specifically expert witness work for for separate property in divorces. So, Andy, welcome to the show.
Thank you. Thank you for having me.
So, what prompted you to get into divorce and expert work with, divorces?
I was following the more traditional accounting work or the accounting route. I graduated from school. I worked at an audit at a Big Four accounting firm, and then went on to work in the internal accounting department at a private equity firm. And it was just a little bit too cyclical for me. Was looking for a little bit something a little bit different, something a little bit more gray rather than black or white, which is harder to find in accounting. And I stumbled upon a job posting for a firm in Los Angeles called Gersey Schneider. And Gersey Schneider has a department of 70 plus accountants, maybe now bigger, that focuses on nothing but valuation and litigation support in high net worth divorce matters in Southern California. And it was a really great starting point for me to get into the field that I am now in, because when you're in college and you're in an accounting major, there's no track for family law forensic accounting. It's kind of something you just have to get into or fall into.
And how did you end up in Denver with Harper Hofer and Associates?
I would say we're a little bit of a cost of living refugee. My wife and I are cost of living refugees from the LA area. My wife is a Colorado native. I'm originally from Texas, but I like to say I came with a native. We just thought it would be a good place to live and raise a family. And somebody at my firm in California had left right when I was starting at that firm to work in Denver, and she had worked with Preston. And so I called her up and she said, let me put you in touch. If you're going to be working in forensic accounting, family law focused in Denver, Colorado, Preston Hofer is the guy. That's how I got put in touch with Harper Hofer.
Well, we're here to talk about separate property and tracing. You and I have talked about the differences between California and Colorado. I'm always interested to see or hear about financial experts and their familiarity with the law. So, for our listeners, what's your understanding of separate property and marital property? And we'll get into kind of what you exactly do.
Okay. And kind of, you brought up the comparison of Colorado and California, and at the firm I was at in California, they had a dedicated tracing department. It was about 6 or 7 people that did nothing but separate property tracings. We also had our own proprietary tracing software. You would enter all the transactions in, and you could run it under different scenarios. And I worked for 3 years in California, but my understanding is that through statute and case law, the rules of separate property tracing, especially when you get into more of the details, was a lot more defined in California than it is in Colorado. I get out to Colorado, and Preston kind of says, well, it's kind of, as far as separate property tracing, Colorado is a little bit the Wild West. The statute provides some very, very basic guidance as far as what's separate property. And there is some case law, nothing that is, I would say, too definitive, especially when you get into the minutia of all the different nooks and crannies that you come into with separate property tracings. But the general statute is section 1410.113, And the takeaways from that are, if the court, this is funny because if the court determines that something is your separate property, then it's, my understanding is that it's not subject to division by the court. But what's funny is the court is the one who ultimately determines whether something meets the threshold of qualifying as separate property. And so, you know, the one of the big differences between California and Colorado is that in Colorado, increases in the value of a separate property asset are marital. And backing up a little bit is, how do you have a separate property asset? Separate property assets are generally acquired by one of two ways. It's assets that one party owns when the marriage begins. So it's something you own at the marriage, something that you acquired before you got married. And then also assets that you received generally as a gift or inheritance in your name only during the marriage. Generally, that's the only two ways that you can you can begin with separate property, and that separate property can increase during the marriage only through receipt of additional separate property through gift or inheritance, because it can't grow in value, which is something very important to remember.
Absolutely. And we previously had an episode on trusts with Kim Willoughby, who I'm sure you've worked with a fair amount.
Yep.
And Kim, she observed that Colorado has a liberal approach to classifying, marital property, and it's presumed everything that's acquired after the date of marriage is presumed to be marital. And I think it's fascinating. You and I have talked about, and we'll get into a hypothetical to tease out in terms of the differences with California and Colorado. I think you are absolutely right in terms of Colorado being the Wild West. It's east of California, but it certainly is wide open as far as characterization of separate property and tracing. So we'll get into what tracing means and what that all entails. But I think it's helpful to set the stage. And as listeners of the podcast know, we frequently will use a hypothetical Eric Wolf, and we refer to that in our episode 1. It's on our website. But let's say that Eric Wolf, he's going through a divorce with Melanie, and he owned both a business and a fairly significant stock portfolio in California. And Melanie and him get married in California, and then they become cost of living refugees or transplants, like your wife and you, Andy, and they move to Colorado. Let's say they go to Boulder or Denver, and they live here for a period of time, and then they go through a divorce. So what does it mean to trace? First of all, I guess before we get into the tracing, that business in that stock portfolio, that is separate property because it was owned when Eric and Melanie got married, right?
Correct.
So when we talk about tracing, what are we talking about with respect to separate property in Eric Wolf's stock portfolio and his business?
So the key to tracing is that you have to trace the asset, the separate property asset, from when it first entered the realm of separate property, either at the date of marriage because it existed then, or when it was received as a date of gift. You have to trace it from that point in time, and that specific asset to where it exists today, because it's really only relevant because you're trying to claim something, or one of the parties is trying to claim something that exists today as their separate property. If it was separate property and it was spent, and we can get into that later on in the episode, but if it doesn't exist right now, it's not really relevant, because you're talking about what exists now, and what portion of what exists now you can claim as your separate property. But if it's a stock, you have to say, okay, this is the value of the stock at, let's say, the date of marriage, and I have shown where that value has been all throughout the marriage and where it is today. And I can show you the whole chain of transactions that show where the stock was when I originally received it or when we got married and where it is today. Let's say, you had a stock and you sold it and you bought a different stock, and then you sold it and you bought a different stock, and then you sold it and you bought a car. And then you sold that car and you bought a different car. That's a tracing of following that value from where it was then to where it is now.
So if we kind of separate out the Eric Wolf's business when he owned it in California from the stock portfolio. So the business, if he owned a software business in California, it was worth $10 million when they got married. Now it's worth $15 million when they got married. You can clearly trace it's the same software company that it was before, right? So there's the tracing's pretty easy. There's really no tracing because it's still the same company. It's just a matter of what was it worth at the date of marriage versus what it's worth now.
That's exactly right. That is the interest in the business is your separate property asset. So you say, okay, what was the separate property asset, in this case, the business interest, worth when I got married, and what's it worth now? And you're right, just like you said, the increase would be marital property. But what that would require is us doing what we call a retrospective valuation. What was Eric Wolf's interest in the business worth at the date of marriage, and what is it worth now? So that would require two separate business valuations, potentially.
Okay, so let's talk about the stock portfolio, because that's when the aspects of tracing really become apparent. What are the kind of, we talked about the Wild West, and you said California had very specific provisions with regard to tracing. So when we're getting into the stock portfolio and we're tracing the stocks from from one to the other,
Yeah.
where are the cases in Colorado that are guiding us? Because 1410 doesn't specifically outline what you as a financial expert are supposed to do on tracing. So we're kind of left to case law telling you how to do your job. So what are the cases that you're referencing when you're doing this work?
So there's kind of two approaches to how you look at the stock portfolio, and then there are cases that attorneys frequently use to justify those approaches, and those two approaches are called the aggregate approach and the strict entity approach. And I'll give an example here, just a very simple example. But the real question is statute says increase in an asset is marital property. But the question is, which case law and court rulings, to my knowledge, don't really clarify, is what is an asset? Is an asset an individual stock, or is an asset the account that you hold multiple stocks in? And here's why that matters. Let's say you have a brokerage account with two stocks in it, and you've got IBM and you've got Microsoft, and you get married, and at the date of marriage, both of those stocks are worth $50. Okay. And then the IBM stock goes down to $25, and the Microsoft stock goes up in value to $75. Well, the account, and that's at the date of permanent order separation. The account in total was worth $100 at the date of marriage, and it's worth $100 now. So if you're looking at the account as the asset, the account hasn't gone up in value, and the separate property holder of that account would say the account was worth $100 then, it's worth $100 now, it's all my separate property. But if you consider the asset to not be the account, but each stock held within the account, you would say, no. The Microsoft stock has gone up in value by $25. So that share is actually $25 marital property, and the rest is separate property. And then because the IBM share went down in value, it's all separate property. So under that approach, the account would be $25 marital property and $75 separate property instead of entirely separate property. And I've seen both of those approaches made, and the case that is used for saying that the entire account is one asset is in Marriage of Powell. And then the case that I've seen where they say, you need to look at each specific asset is in Marriage of Balanson.
And I think
Oh,
Burford.
I'm sorry. Let me clarify. Burford.
Right, and Balanson is a case kind of involving when we dealing with stock options and some other things. So to kind of to summarize, if we had Eric Wolf and he had a stock portfolio, it was $100 when Melanie and him got married in California. It's worth $100 when they get divorced under Powell, and you're looking at the kind of strict entity, and it's all just one brokerage. It would be there's no marital property because there's no increase in value. But Burford, then you're getting into which stock went up, and then further confusing is if you have IBM that has gone down in value, and then it's subsequently traded to Tesla, for example, 5 years ago, and then Tesla goes through the roof. What in that circumstance, what happens?
So let's say it was $50. It goes down to 25. You sell it. When you sell it, those entire sales proceeds are separate property. And then you take that $25 that's separate and you follow it, and it goes into Tesla. And you buy Tesla, and it goes up to $100. We'll say it's probably much more than that, but 100. Well, then, this is what I mentioned earlier. Separate property cannot increase in value. So your $25, your Tesla share that's worth $100 is still your $25 of separate property, and then $75 of marital property. And then, let's say you sell that Tesla share for $100. Well, then those sales proceeds are still going to be $75 of marital property, and then 25 of marital of separate property. And the way to kind of think about it is this, like, the game that you play with the ball, and they're like, when you go to a Nuggets game and they're moving the cups around and the ball's in one of the cups. The ball is your $25 of separate property. And when you're tracing, you got to keep your eye on the ball and not worry so much about the other stuff, because that's really all that matters, is that $25 of separate property and following it and saying, where is it going?
And do you think it's fair to say that ball that you're tracing or following at the Nuggets game, it just gets smaller and smaller and smaller because of the way that the law works here in Colorado?
That's correct. Yes, it can only shrink. It cannot grow. That's the number one thing to remember. If you see a tracing and somebody's claiming that they have more separate property at the end of the marriage than at the beginning, that's a huge red flag. I mean, unless of course we're talking about, there were gifts received or things like that. But yes, over time, especially if you hold stocks, they decrease in value. Especially if you trade a lot. If you take money out of an account for something that can't be traced. If you spend separate property on travel or restaurants, it's gone because it's not going into an asset that still exists. And so all those things, we call it diminution of separate property. And so generally the rule of thumb is the longer a marriage and the more activity there is as far as these assets that contain separate property, the more diminution you're going to have. And so a lot of times Preston and I will look at a case and somebody says, I want to trace some separate property over 10, 15, 20 years in this account that was being traded, every day or every week. We're going to say, I mean, yeah, we'll give it a shot. We can do it, but there's probably going to be a lot of diminution of separate property, and it's going to cost a lot to follow, to trace it through these multiple time periods and across all these transactions.
When you say it takes a lot of time, what does that work entail, Andy? I mean, are you sitting down with each month's brokerage statement and going through every transaction?
That's correct. I mean, we luckily, the process has become a lot more automated. We have a software that we use called ScanWriter, and what that does is you can send me your Bank of America, your Merrill Lynch brokerage statement, and I have a software that will read it and download each and every transaction. Every time you bought a stock, sold a stock, every time there was a stock split, every time you received interest, every time you received a dividend, all of those things impact the mix of separate and marital property in the account. So they all need to be tracked. Generally, there are exceptions, but all of those transactions impact separate property and need to be accounted for. And so what we do is we'll put that into our reader, and then that goes into Excel, and we kind of have to clean the data. And then we have an Excel model, and we can run different tracing assumptions on that model. But it is quite, it can be a tedious and detail oriented process for sure, especially if there's a lot of transactions and it's a long time period.
What about a mutual fund or a hedge fund that is actively trading? You own the mutual fund, but that mutual fund is Tesla, Netflix, IBM, and just churning. What happens in that circumstance?
Then it's not as complicated because the asset is your interest in that mutual fund, and we don't really care what is going on within that mutual fund. That would be that wouldn't even be feasible as far as tracing. We just look at, okay, you purchased the mutual fund for X dollars, with separate property. Let's say that's your separate property basis. What is the one share of the mutual fund now worth today? Did it go up or down in value? And the same thing with a private equity fund or a hedge fund. If you invested in private equity fund, you know what you bought in at, and the private equity fund or hedge funds usually send out quarterly statements saying, hey, this is what your interest in our fund is worth.
So if Eric Wolf's a hedge fund manager, it's about how much his hedge fund is worth at the date of marriage versus now. It's not all the stocks that he's trading, because the asset that you're defining is the hedge fund business.
Yeah, I would clarify by saying more so if he's a hedge fund investor. It's if he's a hedge fund manager, that would be a separate thing where we would value his interest, his ownership interest in the hedge fund as a manager. But if he's a hedge fund investor, it would be, yeah, just what is his interest in the hedge fund worth, at the separate property date, and versus what is it worth at the date of separation.
What happens, Andy, if Eric says, I did this all in California. California's got very specific rules. Doesn't Colorado follow those rules? Because I had this stock portfolio in California. Doesn't California law apply?
That's more an argument for you to make. But but we can and have done it both ways. When I started working for Preston, I actually worked on a large case, where in California, increases in separate property are separate. And so the attorney for the client was making that argument that even though it was in Colorado courts, California tracing law should apply. And we did it both ways. We did it under California tracing law, and then under Colorado statute. So you can make that argument for sure, and we can provide you with the tools and the support to make that argument. And then it's just a matter of whether the trier of fact buys that.
So essentially, what you were asked to do were to say that, geez, Eric, he basically lost several $1 million by moving from California to Colorado. That's unfair, and it's up to the divorce attorney to make that argument. You, as a financial expert, are just arming the divorce attorney with the quality, or not the quality, the quantitative amount. So you can say, this is what it would have happened under California law, the dollar amount versus the dollar amount here in Colorado.
That's correct. Yeah, we're providing them with a number to give the judge, and I mean, because Colorado is so undefined as far as tracing approaches, we will provide. We've worked with a lot of attorneys that take different approaches as far as just how to treat separate property and withdrawals and increases and et cetera. And they will say, hey, please run it under this assumption or that assumption, and we can do that to provide them with the tools so that they can tell the judge, this is why we think that this approach is most appropriate, and this is the number of separate property that you come up with using that approach.
Okay, so let's shift gears a little bit. Eric Wolf, he's got the stock portfolio. He owns it at the date of marriage. What happens if over during the marriage, Andy, Eric is depositing money into that stock portfolio and making investments? What happens when you have a combination of marital property, the property deposited after the date of marriage, versus what was in there before?
That's a good question. That becomes what we call a commingled account. It's a commingled account. It includes separate property and marital property. And because of the way that Colorado treats increases in separate property, almost all accounts are commingled accounts because they generally increase in value, which people will call the Accountants Full Employment Act, because we have to uncommingle or uncommingle the account. But yeah, there's two ways that when you have a beginning account that includes only separate property, that marital property can come in, and that's when the separate property increases in value, or when when additional marital funds are put into the account. And then the next question is, okay, we have a commingled account and money comes out of that account. Is that money coming out of the account separate or marital, or a little bit of both?
Right. So if Eric and Melanie move to Boulder, buy a house at the base of Flatirons, in Chautauqua, and he withdraws money from that stock portfolio, walk us through what you're looking for. And does it matter if that house is separately titled or jointly titled?
Okay. I mean, I would say, first of all, generally, I mean, you can make arguments to the contrary, and a lot of attorneys have, but generally, if he buys that account in joint title, then whatever equity he puts into that house is marital property, just solely due to titling. So
Right.
that's something
So
to look out
if he
for.
withdraws $1 million from that account, the stock portfolio, he's then doesn't matter if what the percentage is of what he withdrew, but what was gone, what went into the house is now marital property. But what's remaining? What happens if he withdraws $1 million from that stock portfolio, but there's still $9 million left in that portfolio?
Well, I mean, so we would look at different ways to classify that $1 million that he withdrew. But as long as that stock portfolio is still titled in his name, whatever separate property he hasn't withdrawn still remains in that account. But let's say that he titles the house in his name only. So then theoretically, he can take separate property in that account and he can move it into the house and it remains his separate property. But then the question is, let's say he takes $1 million in cash. Well, I mean, cash, you can't, when you're looking at cash, you can't really tell. There's no way to tell marital dollars and separate dollars. So there's a couple different approaches. The default approach, if there's no stated intent as far as his intent to use separate or marital money, is what we call pro rata. So when you're doing a tracing, and I talked about all those different transactions like dividends and interest and sales and stuff like that, the reason you have to track all of those is because you have to know what the separate and marital mix of money in that account is at any given time, because you have to know what it is when money comes out of that account. And pro rata is, let's say let's say we know that the account is 60% separate, 40% marital. Under pro rata, when $1,000,000 comes out, we're going to say, okay, 600,000 of those dollars is separate and 400,000 of those is marital. The argument can also be made, and these arguments are generally supposed to be supported by the intent of the party. Let's say Eric says, I intended to use my separate property to buy that house. I titled it separately. I intended to use my separate property. I even have, this is very rare, but let's say he has an email where he sends an email to his financial advisor and says, I want to pay for the house, the down payment on the house from this account because I want to use my separate property. Well, then his argument is that he intended to use his separate funds only to purchase this house, so that when you pull that $1,000,000 out of the brokerage account and put it into the house for tracing purposes, you assume that all those $1,000,000 is separate. And then you can also make the converse argument where he says this is a marital house. This is what we're going to live in, and I titled it jointly with my wife. And this is a marital house. We're living in there. I intended to use marital funds. So in that case, you can assume that $1,000,000 coming out is coming only from marital funds. And I've seen all three arguments made: separate first, marital first, or pro rata.
So if Eric withdraws $1,000,000 separately, solely titles the house, then he's going to be able to, under a pro rata approach, say, well, 600,000 is separate property, and then of course you're dealing with the increase on the value of the house, but then you're keeping your eye on the ball, and that's $600,000.
Correct. That's correct.
What other things are you trying to, keep your eye on the ball, so to speak, to continue with that metaphor, when you've got a running total of the separate property when you're doing a tracing?
So the running total is important, especially when you're using those two approaches, what I call intent-based approaches, where you say, I intended to use only separate property, or I intended to use only marital property. And the reason that a running total is important is because Eric can say, hey, I intended to use separate property to fund that $1,000,000. But if you're doing a tracing and you are keeping a running total of how much separate and how much marital is in the account at any given time, well, then let's say that there's only $300,000 of separate property in the account at the time that he took out that $1,000,000. Well, you say, great, Eric, you intended to use your separate property, but you only had $300,000 of separate property in that account at the time that you withdrew that $1,000,000. So therefore, the remaining $700,000 has to be from marital property. And that can be vice versa. It can be the other way around too. If he says I intended to use marital and there was only 300,000 of marital, well, that's all there is in the account. You can't make something from nothing. And so that's why it's important to keep this running total, to know how much separate and marital is in the account at any given time.
What happens, Andy, if Eric uses that stock portfolio and takes out a loan to buy a house?
Okay, that's a good question. Loans can be very confusing, and the simplest way to think about it is that a loan isn't separate or marital property. A loan is a bridge between the asset that you buy with the loan proceeds and the money that you use to ultimately pay down that loan. So it's kind of, you don't know. Let's say somebody takes out a loan and buys an asset. You don't necessarily know whether that asset is separate or marital property until you know what money was used to pay down that loan. Because again, it's a bridge. It's a temporary holder between something you're buying and what the actual money that you're using to pay for it.
Right, but the loan, if and I wasn't really clear in terms of the example, but if the portfolio or separate property is used as collateral for the loan, and that loan is a marital debt, it doesn't convert the separate property portfolio into marital just because it was used as a loan during the marriage.
That's correct. But what somebody can argue is that because you used your separate property as collateral, that kind of shows your intention to, a lot of times during the marriage there'll be outstanding debt, and so we don't necessarily know at the date of separation what money will be used to pay down that debt because it hasn't been paid down yet. And so the court has to make an assumption as far as, let's say you took on debt to purchase a house. Does he intend to pay down that debt with separate property or marital property? And using it, if he uses his separate property as collateral for that loan, that would be maybe an indicator that he intended to that he intended to use his separate property to pay down that debt. So I mean, it's confusing because you don't know what funds have, because the debt hasn't been paid down. You don't know whether separate or marital funds is going to be used to pay down that debt, and you have
Right.
to
So
make an
if
assumption.
Right. So if Eric and Melanie buy a house, they get a mortgage, and then they use the stock portfolio over time, Eric's separate property or a combination, that commingled account, to pay down the mortgage. Is that what are you tracing the separate property that's going into paying down that mortgage, even if it's a joint mortgage?
Joint mortgage. Okay, let's say it's a joint mortgage and the house is jointly titled. Okay, so every time, and this is kind of again following the ball. Every time that Eric uses his separate property to pay down the mortgage, he's essentially moving his separate property into a jointly titled asset and therefore converting it to marital property. As he does it, he's cutting off a piece of the ball and moving it into the house, and the ball is turning into marital property.
So it would matter if that house was solely titled in Eric's name and the mortgage was solely titled in his name, and then over time he uses the portfolio to pay down that mortgage.
Correct. Yep. That's and wife is going to probably argue if the mortgage is still outstanding at the date of marriage. Hey, he actually intended to use all his separate property eventually to pay down that mortgage. So therefore, you should take all the separate property that is needed to pay down the mortgage and convert that to marital property to satisfy the mortgage. Where Eric would say, "No, actually, I probably was going to use marital funds to pay that off." You'd look
Real
at what he
estate's
was doing too.
Yeah, real estate's a fascinating, in terms of separate property, because you have both the value of the house. Let's say it's $1 million house. And I mean, we've been going through in part because of from California and elsewhere, people are moving to Colorado, especially up in the mountains. So property prices have increased. So you have
Yep.
that increase as an opportunity for marital, a marital property if the house was separate. But then you also have the payment down of, most people have mortgages. And so you have the payment of the debt, which increases the equity. So would you agree that there's two opportunities in real estate for marital property, both the increase in value of the real estate versus the reduction of debt against that house?
Correct. Yep. What I guess what you're referring to is appreciation equity versus I guess I'd call it direct equity. And so appreciation equity is always going to be marital. Direct equity depends on whether that direct equity was funded with separate property or marital property.
Right. Because if the reduction of the mortgage over is $10,000 per payment, but that $10,000 is separate property to begin with, you're able to trace that and keep your eye on the ball. And it's that reduction in debt. It's not necessarily marital. It's because you're tracing it from separate property.
Correct. Yep. It's just taking separate property from one place and moving it to a new place.
Now, let's talk about income tax considerations. What are things that you're looking at? If Melanie and Eric are paying capital gains or dividends on that stock portfolio that he owned when they got married, what does that matter?
So generally, income taxes are on income, and income earned during the marriage is marital property. Income is marital property. So generally, tax liabilities are marital liabilities. And if somebody uses their separate property to pay an income tax liability, generally that's a marital liability, then I consider that generally to be a gift to the marital estate. I mean, it can be considered by the court saying, "Hey, I use my separate property to pay marital liabilities." The one instance where a tax liability is a separate property liability is, let's say somebody at the date of marriage holds Tesla stock, okay, and it's worth $1,000 a share, and they only paid $100 a share, way before the marriage, but at the date of marriage, it's worth $1,000 a share. So you have a share of Tesla, it's worth $1,000. It's your separate property. And let's say, the first year of marriage, you sell that share of Tesla. Well, you're going to owe tax on that. And let's say you sell it for $1,000. You're going to owe tax on that. And that gain was achieved before the marriage. You owe tax on a gain relating to your separate property. That debt that tax liability is a separate property tax liability, and if it's paid if it's paid with marital funds and not paid with separate funds, then I would say that the marital or the separate estate, the separatizer owes a reimbursement to the marital estate.
Got it. So if there is a stock portfolio that was had a significant tax bill at the date of marriage, and then fast forward a couple years, once that tax bill becomes due during the marriage, if the marital estate pays it all, then Eric would need to reimburse the marital estate for what he would have owed at the date of marriage.
That's correct.
Okay. What about stock options, Andy? Like, how are those treated? I mean, the case in your marriage of Powell, it dealt significantly with stock options. What happens in that circumstance with separate property and tracing?
So I don't recall, was that an employment related stock option
Yes.
or? Okay. So the one thing with employment is, um, you know, stock options in conjunction with employment are employment related income. And if for your efforts, a party's efforts, if the stock options are awarded as compensation for the one party's efforts during the marriage, then they are marital property. But if they are awarded wholly or partially for efforts that they put forth prior to the marriage or will put forth after the marriage, then those are separate property. And so it gets tricky. So, was the stock option awarded for your past service, or is it awarded for your future service? Another thing that we have to look at is there's some case law that looks at vesting. Are these stock options vested? And if they're not vested, they're not necessarily property, and therefore they can't be marital property. And then one other thing that we can calculate is called a time rule formula. And that looks at, if the period of, service that somebody is providing in order to get these stock options straddles the date of marriage or the date of divorce, then what we can do is a time rule. We can say, okay, 60% of this stock option relates to service that will be done during the marriage, and 40% relates to, service that will be done after the marriage. So based on that, 40% of the value of this option is separate property, and 60% is marital property.
And you financial analysts will do the same thing with a para or defined benefit retirement plan, right? Where if
That's
someone
correct.
was working, they were a teacher, Melanie was a teacher, and had acquired some service before she met Eric in para, which is the defined pension plan with for teachers in Colorado, and then they get married, and then she continued being a teacher, then you can figure out, well, her dates of service, 40% were before the marriage and 60% were after the marriage. And so you can do a time roll and figuring out what portion of those retirement benefits, as well as stock options, are marital versus separate.
That's correct. Yeah, we can work with para and other retirement plans, and then we can do present value calculations to figure out, yeah, what was their benefit, what was the retirement benefit that they had earned, when the marriage started, and what's the retirement benefit that they've earned now, and then the delta between those two is the marital increase. Yep, that's correct.
Well, I find it. I mean, it's hard to explain these concepts to clients, and they are frequently confused, upset, especially under the Burford when you explain to them that essentially you get to cherry pick, the appreciation, and obviously if someone like Eric who has separate property, they are extremely upset whenever I have to explain that to them, and then they also have to be they have to be advised, or we have to tell them in terms of how much it's going to cost, but it can be often worth it. And I think it's fascinating work what you guys do, and we could go on and on. And but Andy, thank you so much for the time. And if people want to find out more, divorce lawyers or other people going through a divorce that may have separate property or business valuations, where can they find you? Do you guys do?
A lot of what we do is business valuation. And then we'll do income analysis where we'll look at each party's income, for maintenance and support purposes. But I'd say and we'll also value pension plans, like somebody's interest in a para plan. That's the big areas is tracing, income analysis, and business valuation.
And I mentioned we had an episode with Kim Willoughby with trust. You will also value beneficiary interests in trust, right?
That's correct, especially if they um, contain assets that are not necessarily easily, where the value can't just be easily looked up.
Well, Andy, thanks again for joining us on Divorce at Altitude. Lots to talk about with tracing. It can get really complex, but for people that need you, they know where to find you now. But thanks again for joining us and the time today.
Yeah, no problem. And like you said, sometimes there's enough money at stake to where it's worth the expense to do it.
Absolutely. Well, thanks again, Andy.
All right, thank you for having me.